with. And for the recording, we're talking about central bank dealers range. This is part 1 of the intraday trading series. So does anybody know what the central bank dealers range is, or can anybody guess? It doesn't matter if you get it right, just guess.
Central bank doing their sale and purchase within that range.
Okay. All right. Can anybody else hazard a guess?
So it is a time between in India there is a 12 a.m. to 5:30 a.m. in which bank has their contract sets and they have planned all their move for the days, and which we can get by the CBDR.
Okay, right. So it's so I think you've heard it before already. So this is pretty so the way you explain it is pretty simple, right? It's essentially this is the time where the central banks, right, the people who run the market, this is the time of day that they are going to be essentially running the this is where their orders are going to be run, right? So their orders are going to be placed, orders can be closed. Basically, this is a zone of essentially lower volatility that's going to set the tone of the day. So this is the point in time where we're actually going to write this down. We're going to say point in time where central banks run their orders and the algo sets up for the next trading day. So I know a lot of you guys think, for example, let's take this for example. Everybody knows that at the end of New York, after 1 p.m., the market kind of slows down, right? Am I right? The market basically slows down through these days, and whenever the market slows down during those hours, there's usually not many setups that we can take. And volatility slows down, price usually consolidates. And usually that's a bad thing for us traders, right? But that's also a good thing because it also indicates essentially what's going to happen or what we can do later on. So what we can do is we're actually going to point out exactly what times it's done. So CBDR starts from 2 p.m. Eastern time and ends 8 p.m. Eastern time. Okay. So if you're in India, I need you guys to quickly look up on Google or wherever you are. I need you to look up on Google my time zone to New York time zone, okay, or Eastern time converter. Or you can say, or you can even type into Google, what time is it in New York City? Okay, what time is it in New York? And it'll tell you that right now it's 11:26 a.m. Okay, so if it's 11:26 a.m. right now, that essentially means whatever time in India, we're ahead or we're behind that many hours, or Australia, or we have a lot of students on right now, so it's a big crowd of people. Now, that being said, these people, this time zone, okay, you're going to need to write it down somewhere. You're going to need to put it somewhere, because this is the kind of universal time where everything is set. Okay, so that's when everything is run. Okay, so that's when it happens, right? It happens very, very quickly, over the span of a couple hours. Right. And the first thing that you need to know, right, about this is that it runs on standard deviations. Does anybody not know what standard deviations are? Does anybody not know what standard deviations are?
Yes, I don't know.
Okay, drop a 2 in the chat if you don't know what a standard deviation is. It's okay if you don't. Just let me know. I need to know. Okay, all right. So there's a couple people that don't know what a standard deviation is. Don't worry, we will explain it to you in just one moment. So we can ignore that for a moment. Okay. And then the last one is that the range must be less than or equal to around 30 pips. And we can put as a little side note, any larger than 30 pips usually leads to bad projections. Okay. So first things first, we need to know what a standard deviation is. So let's actually move over. Oh, we can't move over. Okay. Let's move higher. Okay. And we're going to talk about what a standard deviation is. Okay. Now, a standard deviation is very simple. All that it is simply a movement away from a certain measurement. Okay. So, for example, it's usually used in statistics, okay, to differentiate data. Okay, usually it's used in statistics. So it's not a concept that a lot of people are familiar with, but that's okay because how we explain it is very simple. Let's say we have this set of like this little square, right? Or this little rectangle. And let's say that this rectangle measures 20 pips. Okay. So this is the 0th. Okay, this is the origin. So this doesn't count. Okay, this doesn't count. So we can call this the 0th generation or deviation, or we can call it the origin. Okay. Now this is the baseline. Okay, this is the origin of where all the other standard deviations come from. All right. So if this is 20 pips, that means that if we copy this, right, exactly for how it is, right, that means that this rectangle is also 20 pips. There's a difference though. As soon as we put these on top of each other, right, as soon as we put them together, how many pips is this? How many pips is that?
40
40 pips, right? 40 pips, very simple. So since it's 40 pips, what ends up happening, right, is that how many deviations is it from the origin? If one deviation is 20 pips, if the origin was 20 pips, how many pips away from 20 pips are we?
One.
20
exactly.
one deviation.
Exactly, one, right? One exactly. So what ends up happening, right? What ends up happening is this standard deviation, this is the first standard deviation. So we can call this deviation number 1 or first deviation, whatever you want to call it. Okay. So a deviation is simply a movement away from, whoops, a deviation is simply a movement away from the first set of data. So that's a positive deviation. Now, let's say we went down, right? And we copied this, and then we moved it downward. Now what would we say? Well, is this another standard deviation? Is this one? Is this two? How many deviations is this?
One.
One. It's one standard deviation, but this is one negative deviation. So in statistics, technically it would still be one deviation, right? And technically it is still one deviation, but just to differentiate, right, which way we're going, it's simply a positive deviation if you're going higher and a negative deviation if you're going lower. So now that you understand that, deviations are very simply, they're just skews of data from the origin, okay? And if this right here is the origin, that's our original set of data. Every movement equal to the origin, let's say like every copy equal to the origin that we go up or down, that's one deviation. So now let's say we copy the same thing again, and now we put it another one higher. How many standard deviations have we traveled away from the origin in the positive direction?
3.
Two, not three.
Yes, sir, 2.
Two, because remember the 0th deviation, the origin does not count. Okay, that is the data. Okay, that is the data. So that's not right. Whenever we look at the market, we want to understand that deviation, right? It does not include the first origin. Okay, it does not include. So now we can easily, say that this is the deviation number 2. Now, if we did the exact same thing, but we did it downward, what would it be? It would simply be the second negative deviation. Okay, that's all it is. It's very simple. Does anybody not understand it? Does anybody not understand it? Is anybody having trouble? Everybody has it? Awesome. Okay. Awesome. All right. So now we can easily say right now that we've understood standard deviation. Now, standard deviation has to have a certain amount of data. So where do we get the data, right? Where do we get the origin of the 0th deviation? That's very simple. Let's say we go to USD Swiss, right? Let's say we go here. And let's say we analyze the beginning of this week, which was over here, right? This was February 7th. That was on Monday, I believe. Yes, it was on Monday, right? So we have, so right here marked, we have our Asian range, right? But we don't actually want our Asian range. We want something different. So we're actually going to hide these away. This is February 7th. But remember that it's from 2 p.m. to 8 p.m. EST. So it's from 2 p.m. to 8. So it would have to be from 1400 hours to 20. Okay. So now, where is, oh, we can actually bring it up. It's, which one is this one? All right, it's Patty trading sessions. Okay. I'm not sure why it's not popping up. Is it this one? That's okay. Let's get rid of all of these. Let's keep this one because I need this one. And I'm setting this up so that everybody can see the central bank dealers range. Okay. I don't think we need a background for that. No, we do not. We turn off London and New York, and then we go from 1400 hours, okay, which is 2 p.m. to what is 8 p.m. in military time? 8 p.m. is 20, right?
20.
Yeah, 20. All right, cool. Just didn't want to look like an idiot. All right, here we go. So it's from 1400 hours to 20 hours, okay? Now you can fill it in however you want. You can, do whatever you want with it. It doesn't really matter all that much what you do with it. It just matters that you get the idea correct, right? That's really all that matters. So that being said, usually you want to make it very visible for yourself, okay? And here we go. All right. So now you want to usually stick to about the 1 hour because it gives you the exact hours that it goes from. So you start at the 2 hour candle and you go all the way down to the to the 20. Why did it not include the 20? Hold on. Okay, for some reason it didn't include the 20. Okay, so apparently you have to put it an hour higher for some reason because it doesn't include 20 when it does the calculation. But all right, so now what you want to do is let's actually take a look at this one because this one's actually pretty nice. So every single day, we understand that every daily candle will have to create a high and a low, right? Everybody understands that. Everybody understands that a daily candle will usually end up looking like one of these. It'll have a body, right? And it will either have, a high. So if it's a bullish candle, it will have an open and a low, right? This little tail being the low. And it will also have a high and a close if it's bullish, right? So if it's bullish, right, it closes higher and there's a little bit of wick left on top. Usually this is what a standard buy day looks like, right? And a standard sell day looks the exact opposite. Okay, here we go. So it looks the exact opposite. Actually, did I copy it twice? I did copy it twice. Okay. So the sell day would look similar to this. It would have an open and it would have a close. Okay, everybody understands this, right? Everybody gets it that usually a day that goes higher, opens lower, and then ends higher, right? Very simple. But it usually has some drawdown or some pullback or some movement in the middle, right? These are depicted as daily candles, right, in the middle, and that's what sets up every intraday trade. All right. Now, the central bank dealers range is what's going to help us understand or essentially kind of gauge where the market can go toward in terms of standard deviation. And I'll tell you exactly what to note for when you're looking at standard deviation. All right. So the first things first, I know we have sworn these off forever, and everybody would probably kill me if I use these like at all, ever. But these are necessary. Okay, these are necessary, and they are something that we need to use to kind of maintain our relationship with smart money, mostly intact. So the first thing that I want you to do is I want you to click on your Fibonacci thing, okay, on your menu, but I don't want you to click on Fibonacci. I want you to look at all these. And I want you to actually use something called the GAN box. Okay, the GAN box right here. Does everybody see it? Has everybody found it?
Yes, sir.
Okay. Now, when you click on the GAN box, okay, what I want you to do is I want you to kind of run it from the top of your range, right? The top of your CBDR, and I want you to run it lower, or you could run it from tip to tip, doesn't matter. Now, the reason why you run it low, why you run it like this is because you want to find the deviations. Now, at first, it's not going to look like this. Okay, at first, it's not going to look like this. At first, it's going to look really weird. At first, it's going to look, really, really dumb. But I need you guys to do this very quickly. Okay, I need you guys to copy these settings. Now, you can also flip them around and put, -3, and it'll go your way, like meaning it'll like deploy like a fib. Just very quickly, hold on. So if you do it like this, it'll deploy like a fib, which is fine. I just, it's just annoying to be moving it back and forth. So I just kind of keep it like this. You could, I guess you could do this. Okay. Does everybody have these settings up? So I want you guys to take a picture. I want you guys to, write this down. Everything else is unchecked. Everything else is unchecked. Everything else. I put it on reverse. Ha, whoops. That's funny. So then just leave this as 4. Okay. I put it on reverse for some reason. Yeah. So just leave it like this. Okay. Drop a 1 in the chat when you got this.
Sir, please explain again how you applied this tool.
What do you mean how we applied this tool? How we got it?
No, sir. You had taken that tool, and how did you apply it?
I just clicked
Just
on
pick up
GAN
the tool
box.
again and apply it again.
So I put the GAN box, right? And I ran it from the top of my CBDR to the bottom, depending on what direction. So you place it kind of like a fib. So you run it in whatever direction you think the day is going to go. So if you think the day is going to go higher, then you put it higher, right? You put it from the low to the high. If you think it's going to go lower, then you put it from the high to the low, right? Stuff like that. So it runs the same way as a fib.
Okay, sir. Done.
All right. All right. So does everybody have these settings? I'll put up the settings one more time. All right. So I assume everybody has it. Now, this here is going to help us out a lot because of the fact that it's actually going to help us determine how much the market will move over the next couple hours. Okay. How much the market will move essentially on average, right? How much it has moved on average. So usually how you want to put these is very simple. Usually you want to stay within like I said here, you want to stay within a range that's less than or equal to 30 pips. So this applies to certain pairs, right? To certain other pairs like GA or GN that have very high pip counts. Usually that isn't the case. But you know, in this case on the majors, you want to stick to that same criteria. So let's measure out this range. So how big is this range? If we measure it out, it's about 14 pips. So that is a valid range. That is a valid time that you want to put this on. Now, if we take a look at this week, right, and we actually look at where the CBDR points, right? Let's actually flip the CBDR. Okay. And as you can see, the CBDR actually pointed out and predicted exactly where the weekly high was going to be. You guys see where the weekly high is? The CBDR for this day actually predicted it really nicely, right? Now, if we go back and we see this one here, it was also about 20 pips. Now, remember 20 pips on USD Swiss is a little bit bigger than usual because, you know, this pair isn't very pip heavy. Now you could have also put your CBDR here. Now, in this case, we have a large wick, right? We have a large wick on the bottom here. And wicks are okay as long as they're not enormous, right? So if they're not like huge wicks that are in the middle of your central bank dealers range, usually you want to use the bodies. So you'll use the bodies from here to here, right? And you'll capture kind of the same idea. But usually you don't want to use the wicks. In this case, I also wouldn't use the wicks. I would use the bodies, or you would use a shorter wick like this one. Okay, you would use a shorter wick. Though the body seems good, right? And from here, you can kind of see that the market takes on a very nice approach, right? Because the market actually reaches up into your first standard deviation and creates the high of the day, right? And then from there, drops lower, and then, you know, the next day, the next New York, it comes back and it reacts off of a different area. Now, if we actually, if we turn this on and we turn off Asia session, oh boy, I'm gonna have to adjust this real quick. So we take off Asia and we take off the Asian range fill. There we go. Now, if we do this, right, and we leave it just like this, now what ends up happening? We can see where the new day is, right? This green line is the new day. We can see where New York starts, and now we can see where London starts. Okay, so these are all of our indicators running at once. Now, what do we get from this? Well, from these indicators working together, we understand that the CBDR, right, the central bank dealers range, at all of these times, right, we see that it creates the high of the day during London, right, or right before London. It falls during London, right, and then it rises during New York. So this is a pretty standard London to New York reversal, right, London to New York reversal. But as we can see, price actually created the high of the day while it touched the first central bank dealers range zone or standard deviation. Now, here are some notes to use while you're using your standard deviation. Okay, so I'm actually going to move it over, and I'm gonna write stuff on this side. Okay, now these are going to be pointers on exactly what, how, and when to use your CBDR and what it's for, essentially, right? So firstly, what we just talked about, right? The high and the low of CBDR can be it can be derived using the bodies of candles or the wicks if they are not too long. Okay, very simple. Now, this isn't something that you can just use willy-nilly, right? This isn't just something that you can just pull out and be like, oh, I know where the high of the day is. No, this is just one piece of the puzzle or one piece of the tools that we are going to be using to actually predict the high of the day or predict the low of the day. CBDR will help you. Okay, so this is kind of like a basic. This is kind of like pulling out your binoculars, right? So you're pulling out your binoculars. And for every, we call ourselves snipers in the Forex market. For every good sniper, right, you have to have a spotter or a range finder, right? Somebody that's calling things out for you. And that's exactly what your CBDR is for. Your CBDR is basically calling what ranges you're going to be in, right? Or what ranges the market is going to operate in. So that being said, it should be, pretty derived that this tool needs to be used in conjunction with directional bias or, analysis of where price is going. And some examples are of this. So I'm going to put some examples. It could be power of 3, Judas swings, order blocks. I should put any block. Okay, so stuff like that. Essentially, what I'm saying is that whenever you see, like, let's say on a certain pair, right, you pull out your CBDR and you're analyzing it, right, and on your second standard deviation from, from the lower point, you see, oh, okay, well, there's an order block near the bottom of the second standard deviation. What does that tell you about that order block? If it's within your ranges, what does that tell you? That tells you that it's a lot more high probability, right? Isn't that what it tells you? If it's within your ranges, it tells you, right, that it's more high probability. So if it's within those ranges, right, it's going to be a lot more high probability for you to take, because the market is telling you, hey, I want to operate within this range, and that order block is within that range. So if it hits that order block and then jumps from it, you could have easily gotten that trade because it was within your CBDR range. Okay, and now this tool, right? So what's its purpose? To help predict a high of the day or a low of the day. Whoops. And to find the market's effective range of that day. Now, what are some exceptions to these rules? Does anybody have any questions on these rules, by the way? Firstly, does anybody have any questions on these?
So we have to apply this central bank limit range on 1 hour or another time frame also.
You sound very far away, bro. Can you get a little closer to your mic?
So I was saying that can we use this central bank CBDR in 1 hour or any other time frames also?
I mean, usually you wanna look at it you can look at it on any time frame. It's about the time, right? It's about what time it was on. But I'm looking at it on the hour because it's giving me one candle every hour. But if we wanted to look at it on the 15-minute, look at it on the 15-minute, sure. All right.
Yes, sir.
All right. Does anybody have any questions right now? No questions? All right, cool. So now this So now, sorry, something just happened. I apologize. All right, so what is the effective range of these standard deviations? How many standard deviations do we want to see? Well, and we're gonna go here to the bottom. We're gonna write some more notes. Okay. Most sell days, most buy or sell days happen within 3 standard deviations. Okay, so most buy or sell days, most days happen within 3 standard deviations. All right. This means, right, that essentially on most days, right, on the majority of days, whenever you are looking at your CBDR, you're going to be looking between two or three of these standard deviations for you to catch the low or the high of the day. Now, on ideal days, right, basically days that are textbook perfect, right, which happen often, but these are going to be the ones that you want to aim for, right? On ideal days, high of the day or low of the day happens within 2 standard deviations, right? And standard deviation is just SD, okay? So on ideal days, usually that's why I keep this on 2, not on 3. Usually I keep this on 2 because it allows me to essentially just kind of keep it in this kind of range, right? And say, okay, well, within these 2, if this is an ideal day, this is around the area where I want it to go. But if it's a third, I just kind of visually add it, or I can even just flip it, right? And just say, oh, this is a third, right? And usually you can also use these as TPs, but I will explain that in just one moment, okay? So on ideal days, usually it happens within 2, right? Now, one more thing, right? One more thing that I want to do is very quickly know about news impact days. Usually end up pushing the CBDR. Sorry, whoops. To around 4 deviations. Okay. So like we saw on news impact days, right? Like we saw the other day, very high, heavy news impacts. You want to take a look at heavy news impacts because heavy news impacts usually pushes the CBDR to essentially its limits, right? It pushes it to 4 or sometimes even 5 standard deviations, right? And those are the times where you don't want to be moving price around. But if we take a look at how price was moving this day, the day that all of this happened. So let's actually see what happened, what was going on. So we see, right, that price ended up creating the high of the day, right? Ended up creating the high of the day all the way up here. Now this is what? This is 1, 2, 3, almost 4, right? So almost 4. If we change up these settings and we put this as 5, sorry, like it has to be 5 because this is technically 0. This is 1 standard deviation, 2 standard deviation, 3 standard deviation, 4 standard deviation. So it was within the 4th standard deviation, right? That's essentially what ended up happening. The 4th standard deviation was the one that was how far it went that way. But the day after right here, it was around 30 pips of standard deviation. So do we want to be trading on a day that we get 30 pips of CBDR during a time where there's not supposed to be much volatility? Do we really want to be looking at that? Let's place our CBDR for today. That's very large, right? That's a very, very large CBDR. That's something that I generally don't want to be dealing with. It's just too much hassle, right? And I personally wouldn't like it, right? So you guys see how big the CBDR is. We don't even reach one standard deviation. So today wouldn't have been a very ideal day to trade. But as you can see, on days that have news impact, we actually reach all the way up to 4 standard deviations. And that can be very disrupting, right? But at the same time, our range finding tool will allow us to, to get to get the point to the points or the range finding that we need to understand where price is going. Now, could you have predicted exactly where price was going to stop? Probably not. But it's good to have all of these, set up at least for the week, because that way your CBDR, you can kind of tell, okay, well, price has been around this range this week, right? So it's been going from here to here. It's been going from here to here, right? So it allows us to kind of get a gauge of where the CBDR is going and how it moves. So usually during the week, I don't delete my CBDR. I leave it on there. So that way I can kind of keep my eyes on everything that's going on and I don't, get confused. So I like keeping these up, and usually between, Tuesday, Wednesday, Thursday is when it's going to create highs and lows, right? Yes, so this week we actually saw that Thursday created, the high of the week. And what day created the low of the week? Wednesday created the low of the week. Well, actually, Tuesday did, technically Monday and Wednesday created the lows of the week, and then Thursday created the high, right? So usually, ideally, the high of day or low, high of week and low of week will happen between Tuesday, Thursday. Okay, very simple. Does everybody get this? Most buy or sell days will happen between 3 standard deviations. Okay. On ideal days, high or low of day will happen between 2 standard deviations. And news impact days will usually end up pushing the CBDR around 4 deviations. And usually the high and low of week will happen from Tuesday to Thursday. Does everybody have all of these notes written down or taking a screenshot of most of them? I know it's a lot of writing, but it's essentially what you need to know about the CBDR and why it's useful.
Hello.
Yes.
So basically, just we need to put this CBDR from 2 p.m. EST to 8 p.m. EST, and we
Yes.
can move to any time frame.
Not any time frame. Keep it within the hour to 15-minute. Don't go crazy. Like I said, you guys can put it very easily using this indicator. It's called the PATI trading sessions, right? PATI trading sessions. When you install it, just click on it, click on the settings, and then just use the Asian high, Asian low, and Asian range fill. And you can unclick like literally everything else. And then the inputs will just be from 1400 hours to 2100 hours or whatever your equivalent is. So whatever your equivalent of time is, you'll put it there.
So there is no limit of the price. It can go to positive 3, 4, 5, any of the CBDR.
So usually the CBDR will kind of be like a soft limit. Once we start backtesting with the CBDR, you'll realize that the CBDR is respected very clearly most of the time. Usually the limit's about 5. So the 5 will usually be about the highest I've seen things go, unless there's a very, very high impact. But on normal days, usually the max you'll see it go is around 3. And remember, those are on days that you don't have 30 pip ranges. Day that you have, 10, 15, 20, 30, 15, 20, I meant to say. Those are usually the days that you want to have, pretty good CBDR. So here's another example. So you see that the CBDR is respected. It creates the high of the day during London around the second standard deviation. And then from there it drops. Obviously afterward it retraces and it goes back up, probably, creates this mitigation block, and then you could have taken a sell lower and, or whatever the case would have been, whatever trade you would have wanted to take. There would have been a setup for you, right? But the point is that you saw the high of the day around the second standard deviation and you reacted based off that. You could have done it here too. Right here, price wasn't very, it wasn't very dynamic, but it created the low of the day very close to the second standard deviation. This was also probably a very nice day. It created it very, very close to the second standard deviation. Here, let's measure this one. Just 25 pips, so a little bit larger than usual. Not ideal, but we can try it out. You can see that the low of the day, right? So the low that led into the day was actually created during London, and it was created during the second standard deviation. Right, and then from there, price came up and it continued around that line until the next day. And CBDR usually isn't taken into consideration on Sunday nights, or sorry, Friday nights. Usually isn't taken into consideration. But let's say here happened in 1 standard deviation, right? So remember that the ideal days are 1 to 2 standard deviations. Normal days are 3. High impact days are 4 to 5. Okay, does that make sense?
So basically, CBDR tells us the high and low of the day. It doesn't give us or tells us the point of interest from where we can take the entry for CBDR.
Bro, you sound like you're underwater. I really need you to pull your mic closer or.
So I was telling the CBDR doesn't give us the point of interest from where we can take the entries. It just usually tells us the daily high and the low of the day, isn't it?
So remember what I said earlier, it's a rangefinder, right? So this is only part 1 of the points of the parts where you're going to be able to find the low of the day. This is one of the tools that you're going to use to find the high of the day or the low of the day. Okay, but that does not mean that you're just going to pull out your CBDR and know exactly where the high and lows of the days are going to be. Okay, that's not the case. You're gonna pull out your CBDR and you're going to get a range. And within that range, the high or the low of the day will happen. Okay, and within that range, you will essentially get the information you need. So later on, you'll learn about how to calculate the high of the day, how to calculate the low of the day, using profiles, using other data, using everything that you've learned up until now, to essentially pull it all together and learn how to calculate the high or the low of the day. So this is kind of like your binoculars. You're finding the range of your target within this tool. That's what this tool is for. Does that make sense? All right, cool.
Sir,
Bro. Yeah.
Sir, using this, we can guess our TP. We can.
Oh, how
put
to
our-
use it? How to use it as a TP?
Yes.
Okay, so very simply, just as the high of the day will usually, or the higher the low of the day will be seen by the CBDR, you can usually also identify that price will at least go 1 to 2 standard deviations away from the normal range for it to actually reach, its take profit. Now, this can happen through a span of a couple days, but you kind of, most of the time, these CBDRs will line up with liquidity pools. So let's say, for example, you have a certain range, right? And it ends up, it ends up making the high of the day opposite to you, like opposite. Well, what ends up happening is a lot of the times the take profit, so the take profit at least has to be the original, the bottom of the CBDR. So like, for example, right here, you see that price trace the high of the day on the second standard deviation, and then it goes all the way back and it hits the CBDR. So let's say you would have taken a trade here on, let's say, like the 1 minute, and you took it here. Where would your take profit have been? Well, one of the good things about the CBDR is that it at least has to touch the equal part of the day so that it can create a candle correctly. So that's what I would have targeted right here, right? You could have targeted 1 or 2 here too, but in this case, in hindsight, obviously in our favor, we understand that price reaches 1. So usually, at least, like, you can put your take profits in different ways. You can put your take profit literally as saying, okay, my first take profit will be here, my second one here, and my third one here, right? So you can kind of from the high of the day, you can essentially pick your poison. Now from there, another thing that you could also say is, let's say you're expecting a lower day, right? Let's say you're expecting a bearish day, and the previous low of the day is something that you see. Okay, what you want to do for the most part is, if the previous day low is available, target it. Okay, let's say you're selling from up here and the previous day low is down here, target it. Okay, target the previous day candles. Okay, that will usually end up going in your favor. Usually, targeting those candles will end up pushing you in the right direction. So another little piece of note here is for take profits. Right? So very simply, for take profits, right? If the CBDR low, you target the CBDR low or high depending on the direction. So if you're selling, you target the low. If you're buying, you target the high, right? And then usually your take profit 1 is there. Your take profit 2 is your take profit 2 is on your first standard deviation, and your take profit 3 is on your third standard deviation. And usually, or your second standard deviation. Geez. So usually you can allow yourself to push these in a certain direction and target and get good targets. Now remember that that's simply a tool. If you see a liquidity pool and it is not exactly on your second standard deviation, or it's a little bit below your second standard deviation, what are you going to trust? Your standard deviation or your liquidity pool?
Liquidity pool.
Right, you're going to trust the liquidity pool. So remember that your liquidity pool is exactly what you want to target. You don't want to target anything else, right? If a liquidity pool is available, ignore everything else. but usually liquidity pools will be within your effective range. Does anybody have any questions at this time?
No, sir, not yet. But just let me take the screenshot of the text.
Oh no,
Done, sir.
let me split these apart. All right, there you go. Now you can take a screenshot. And let me actually take a screenshot too. All right. Cool. And I'll send that to the Telegram right now. All right. Now, everybody understands this now, I assume, right? Drop a 1 in the chat if you have understood today's class. Oh, the settings on the indicator? Yeah. So this is how you create like a thing for your CBDR. This is how you create the CBDR itself. So you use Patty trading sessions as an indicator. There you go. And then the indicator itself is the GAN box. And these are the settings.
Sir, we can use it looking to the order flow only. Is that, sir?
Sorry?
We can use the standard deviation looking to the order flow only.
Looking to the what only?
Order flow.
Order
Yeah,
flow.
yeah, order flow. Yeah, yeah. So usually, like, remember, use your CBDR in conjunction with order flow. Don't just use it nilly-willy. Right? You gotta have analysis beforehand. There you go. All right, guys. So I think that's it for today's class. I think on on Tuesday, we're gonna do a little bit more back testing. And then I have to make up a class. So I believe Wednesday, if possible, I'm going to do an extra class on Wednesday, either Wednesday or Monday. I don't know yet. Whichever one of those days, I have to make up a class. So I'm gonna do it then. All right. All right, guys. So I hope everybody enjoyed. I know this was a little bit of a different class, showing you guys how to use this indicator, but it will be very helpful to you guys. So I hope this has helped. Go back test it, go check it out. Unfortunately, I don't think this class will be uploaded anytime soon because there was some things going on with the Vimeo account, and we've been told not to upload anything as of now. But if God permits, the class will be uploaded as soon as we possibly can. All right. So everybody that was here, you were lucky. All right. All right, guys. Well, you guys take care. And hopefully everything works out for us. All right. So see you guys later. Take care.